Professor, I think you're muted. No one on Zoom can hear you.
There are people in here, so I had to mute both. Okay. So now you should be able to hear me. Okay. So let's say you've priced your company against the market and you priced it against comparables. Can you get different pricings against different groups of companies? In fact, let's go back to Tesla, right? I could price Tesla against other electric car companies. You know what I'm probably going to find? It looks cheap. I could price Tesla against automobile companies. They're both pricings, but I'm going to find, this shouldn't surprise you, right? If I ask you, are you a tall person, and you measure height on a relative basis, your answer is going to be very different depending on whether I put you into a room full of NBA players or a room full of jockeys. You're going to look tall in a room full of jockeys because you're all 5 feet tall. Horses don't like you, so you don't see too many Shaquille O'Neals on the back of a horse. I feel sorry for the horse to begin with, right? And you don't see too many 5-footers in the in professional basketball either. Pricing is all about comparison, and you can already see your conclusions can be different. So what I'm laying the foundations for is when you're pricing your company, you can get very different pricings for the same company depending on who you price it against. You price it against just domestic companies, you can conclude your stock looks underpriced. You price it against global companies, can magically become overpriced. You can price it against a sector that is narrowly defined. You're saying, what does that all mean? It means if you're selling me something and I'll let you pick the multiple and the comparables, you can tell me whatever story you want. It's one of the dangers of pricing is based on your choices, you can reflect whatever conclusions you want to come to. Any questions on this? Because we're going to talk, as I said, today we're going to kind of finish up much of pricing. So I want to lay the foundations for that. So now let's go back to where we were in the notes. And we're going to have some fun today because we've done, once you've done the groundwork and you've laid the foundations, you can have fun. So today, as I said, I'm going to play the role of a really naive equity research analyst. I'm going to hit you with one recommendation after another. And by now you have the tools to take me apart. So bring them to play. So here's my first try. I've been hired as the beverage analyst. This is my sector. I've got the PE ratios for each of the companies, expected growth and standard deviation. Use whatever you want with it. But initially, I'm going to try a very, am I on the right page? I think I'm on the right page. Initially, I'm going to take a very simplistic perspective and recommend you buy Hansen Natural, Todd Hunter, and Andre One. Hansen, of course, makes these sodas. I'm sure you've seen the Hansen Natural sodas. I don't even know what Todd Hunter does. It's something really that you don't want to drink, probably. And Andre One makes champagne so cheap that you get a headache just watching the commercial that you used to watch before Christmas, drinking their champagne. What do they share in common? They're the three companies that traded PE ratios less than 10, right? I've left the two additional columns there for a reason. I want you to think about it. Remember, I said most companies that look cheap deserve to be cheap. So take each of these companies and let's start with Todd Hunter and Andre One and tell me what you see as their weaknesses that explain the low PE ratios. They have low growth, right? Hansen Natural looks pretty interesting, right? It's got high growth, but what seems to be its weakest link? It's got high risk. Again, I'm not saying it explains things away, but it means that when I look at those companies, they have low PE ratios. Two of those companies have low PE ratios because of really low growth. And one of them has a low PE ratio because of high risk. Now you're saying, what do I do with this? For the moment, just let it see, because we're going to talk about ways of controlling for these differences. But most of the time, when you see an outlier company, a company trading at a really low PE ratio or a really high PE ratio, there's a good reason. Go looking for that reason. Let's move to a second sector. I get fired as the beverage analyst. I'm now a telecom analyst, and I cover emerging market telecom ADRs since the late 90s. Let me give you a little bit of history. For much of the 20th century, telecom companies outside the US were government-owned. In almost every country, the telecom business was owned by the government. The US, of course, had regulated monopolies, but many of these other countries, the telecom companies, the government-owned company. Starting in the 1980s, these companies were privatized. What does that mean? The government decided to make them public companies. Investors could buy these companies. They were government controlled maybe, but they were publicly traded companies. And in the 1990s, many of these companies decided to get listed in the US because they had access to more capital. So they listed what were called ADRs. Basically, ADRs are just the domestic stocks listed in the US. The nice thing about ADRs is when you get listed as an ADR, your accounting then has to be redone using GAAP. So that makes a difference because I'm looking at PE ratios. The earnings per share, at least in theory, should be computed the same way for these companies. So I've got the PE ratios for these companies and the expected growth rate for these companies. Again, I'm going to play the role of a naive analyst. And I'm going to ask you to buy two stocks. Indosat and Telebrás, they look really cheap to me. Tell me what I'm missing here. One is that growth seems to be a little anemic, but what's the bigger issue?
Inflation of local currency.
The fact that they're emerging, and this was the 1990s when emerging market companies were really emerging market companies and developed market companies. You're saying they're all not necessarily. I have the Danish telecom company. I've got some developed market telecoms. I've got emerging market telecoms. So there are two things that worry me, right? Low growth and the fact that there's high risk. So let's take a look at a way in which we can bring both of these in. So I'm going to go back to the tool I've used multiple times already. I'm going to use a multiple regression. I'm going to use the PE ratio. That's what I'm trying to explain as my dependent variable. And there are two things I'm worried about. Growth, which I can throw in as an independent variable. The other is the fact that some of these companies are emerging market and some are developed market. Now, lots of ways I can try to control for it. Maybe I could use a country risk premium in there, but I wanted to do something quick. So I created what's called a dummy variable. Remember what a dummy variable is in statistics? It takes on a value of 0 or 1. It's actually a very effective way of capturing something that worries you, but you want to bring it in quickly. I took every emerging market company and assigned 1 as its value for the dummy variable. If you're a developed market company, you put 0. So basically, I have two variables, growth rates, and whether you're an emerging market company or a developed market company. I ran the regression. First thing is R squared of 66%. I'm perfectly okay with it. As I said, in any kind of investment regression that makes any sense, you're not going to get 90, 95, 90. Let go of those R squares. The only place you see them is in statistics classes because you're testing something not worth testing. Things like, is there a relationship between how much you eat and how much you weigh? Absolutely. Could I run a regression to show that? Absolutely. You eat 5,000 calories a day, you're going to weigh a ton. Is there a relationship between how much you drink and how low your GPA is? Yes, beyond a tipping point. But statistics classes, somehow they think if they don't deliver R squares of 90%, nobody's going to listen. So get used to R squares of 30, 40, 50% and say, that's okay. 66% R squared. Let's read the output from the regression. The constant, that's the intercept. Think of that as the base from which I'm going to build off my P ratios. Tells me very little other than the overall pricing in the market. When pricing in the market is high, that base is going to be high. The coefficient on growth is 121.22. You're saying, what does that even mean? Every 1% difference in growth rates in this sector increases my PE ratio by 1.11. So if your growth rate as a telecom company is 5% higher than mine, your PE ratio is going to be roughly 6 higher than mine. Basically, take the growth rate times 5. So I've captured the effect of growth in this sector. It's a very specific set. But take a look at the emerging market dummy. Minus 13.85. You're saying, what does that even mean? I give you two telecom companies with the same growth rate in the late 90s. One is an emerging market telecom company. The other is a developed market telecom company. Given how the markets were punishing telecom companies in the pricing, the emerging market telecom company's PE is going to be 13.85 lower than the developed market telecom company. Remember how we dealt with country risk and discounted cash flow valuations? We did this elaborate dance of let's look at the rate income. This is a much cleaner, much more honest way of thinking country risk. It doesn't matter what you think about country risk or what I think about country risk. We're going to let the market tell us what it thinks about country risk. Minus 13. But remember what precipitated this entire analysis? My recommendation that Telebrás and Indosat are cheap, right? So here's what I did. I took Telebrás as just an example. You could try it with Indosat as well. I took, in the late 90s, Telebrás was the telecom company for all of Brazil. Since then, it's been broken up into, I think, 7 different telecom companies. I took the regression, 13.12 is the intercept, 121.22 times the growth rate, minus 13.85 times 1, because it's an emerging market company. My predicted PE is 8.35. What made me interested in Telebrás? It looked cheap at 8.9 times earnings. But after I controlled for the low growth and the high risk, it actually is a little expensive, not cheap, after you control for the variables. So again, multiple regression, I'm bringing it into play. We'll talk about the limits of multiple regressions. I'm probably pushing some of the assumptions you need for multiple regression to work right to their limits. But with a multiple regression, you can at least control for differences that otherwise you'd be just waving your hands, say, on the one hand, on the other hand, and leave me with nothing to do. Any questions? I get fired as a telecom analyst. So now I'm in the European banking analyst. I'm moving all over the world, picking different sectors, hoping nobody's ever read my reports before. So this is the European banking sector in 2010. And I'm reporting price to book ratios. And I've also, in the next 2 columns, given you a measure of return on equity and standard deviation. Why return on equity? Because that's a companion variable. If I just pick based on price to book ratios, I'm going to load up all my money into, I can't even pronounce it, some German something bank, 0.80, trades at less than book value. And you can see that the price to book varies widely across the sector. So I'm going to first look at a very simplistic way you can look for mismatches. Remember we said you want a mismatch, you want a low price to book and a high return equity. Here's a simplistic way. I computed the median price to book and the median return equity. So if you're in a hurry, what can you do? You can look for stocks that trade at a price to book below the median and with returns on equity that are higher than the median. Let's go down, right? So everything below 2.09 is my cheap. The only stock that I think even looks remotely interesting is BNP Paribas. Every other low price to book stock has returns on equity well below the median. I'm not saying go out and load up on BNP Paribas, but it looks like it's mismatched. On the other side, what are you looking for overpriced? You're looking for stocks that are price to book ratios that exceed the median, but have returns on equity that are below the median. Erste Bank, which is I think an East European bank, 10.28%. But you can already see that eyeballing how much work I was able to do this because there are only 18 companies. What if you have 85 companies in your sector? You're going to get dizzy playing this game of what looks cheap, what looks expensive. But if you have a small enough sector, you can see even without bringing in regression statistics, a simplistic way of trying to find that mismatch. Low price to book, high return equity is cheap. High price to book, low return equity is expensive. Because when you do eyeballing, how do you bring in a third dimension, right? As eyeballing I said, you want companies with low price to book, you could bring in a median standard deviation and try to look for companies that help me out. You want cheap company, you want low price to book, you want high return equity, and you want a low standard deviation. You want low standard deviation. As you get more companies and more dimensions, your head is going to start spinning with eyeballing. But you're right. Why just focus on one variable? Why not bring in the risk as well? And that's again the advantage of statistics. I don't care how big your sample gets or how many variables you want to control for. I can run the regression. In this case, I ran the regression of price to book against return equity. High return equity translates to a higher price to book, makes sense, and standard deviation. And I want to be clear here. I need a measure of risk. It doesn't have to be standard deviation. It doesn't have to be betas. In fact, with banks, what might be an even better measure of risk? When you look at a bank and you call it a risky bank, what usually drives you to call a bank risky? What is it? They have low regulatory capital ratios. S&P Capital IQ carries tier 1 capital ratios. If you're looking at banks, you have 30 banks, you can do price to book, return on equity, and tier 1 capital ratios. And my hypothesis would be that companies or banks with low tier one capital ratio should trade at much lower price to book ratios. So don't get caught up in the DCF mindset of risk is non-diversifiable, I have to use betas. When it comes to pricing, whatever the market views as its proxy for risk is what you should be trying to catch. So in this case, the R squared is 79%. The T statistics are all significant. So rather than focus on the R squared, you're looking for statistical significance. So if you ask me, what's a good R squared? My answer is, I have no idea. As long as the regression has statistical significance, each coefficient, then I can live with it. And if you complain about the R squared being low, you know what my response is going to be? I wanted to value the company. You're the one who wanted to price the company. All the regression is doing is holding up a mirror to the noise in the process. And guess what? If you hadn't used a regression, that noise would still be here. I'm just being open about the fact that this is a very messed up regression. My range or my prediction is going to be much bigger as a consequence. So what I did was I took the regression. I got predicted price to book ratios for each company. So basically plug in the return equity and the standard deviation. And what you're looking for is the difference between the actual and the predicted. That is what's going to drive whether a stock is undervalued or overvalued, not whether a stock looks cheap relative to the rest of the companies. Now let's look at a much bigger sample, because I mean, remember when you look at cross data, you don't have to say it's 15, 20, you can go to 100. So these are actually the 100 largest market cap firms in the US in January 2010. It took me 3 minutes to put up this. So all I did was I went to S&P Capital IQ, downloaded price, downloaded book value, and downloaded net income. I could have actually downloaded price to book and return equity from S&P Capital IQ, but I have no idea what they do to compute those ratios. Whereas if I have price, book value, net income, price divided by book value, of course, is my price to book. Net income divided by book value is my return equity. And it is scatter plot. Scatter plot very simply takes every company in your sample, 100 companies, and plots them on the graph based on the price to book and return equity. So if you wanted to, you could actually count the number of dots. It should be exactly 100. So if any of you are type A personalities and say he's lying, I'm sure it's a smaller sample, go and count the dots. Each dot is a company. You're saying, what are these damn lines that you've drawn through them? It's a nice thing about using Excel or I actually use SPSS, but you can use any statistics package. I don't know what they have at the school. Is it, you know, what Minitab is, or what you have? Is it? No, but within Excel, I can do most of my stuff. So within Excel, if you wanted to, you can stay within Excel. You know what these lines are? They're best fit lines through those dots. And in fact, most statistics packages, if you have a scatter plot, will give you that option of, do you want me to show the line? And I said, absolutely, show me the line. So that's a middle line, that's a best fit line. You're saying, what are these two outer lines? When you have a best fit line, it comes with a standard error. So basically, this package that I use, SPSS, actually draws, I think, the 90th percentile. And here's the way to think about it. If your stock falls between these two lines, statistically, I can't reject the hypothesis that the stock is fairly priced. So what am I looking for? I'm looking for stocks that fall either above the line or below the line. So help me out here. What are the stocks above the line? Are they my most overpriced stocks or underpriced stocks? They're the most overpriced stocks, and the stocks below the line are underpriced. And I'm going to list out the companies, and I want you to think about what they share in common, because then that might be an indication that I'm missing something else. The three most overpriced stocks were Gilead, which was this high growth pharma company, Infosys, and Google. This is 2010. What do they share in common? Young tech companies, growth companies, probably screwed up book values because of the way accounting deals with CapEx in these sectors. Debt is an issue, but I think debt, a lot of other companies also share, but it's a high. So basically already you're getting a signal that maybe you're missing growth. Maybe that's why high growth companies are looking cheap, because price, and if you think about the drivers of price to book, it was return equity, growth, risk, and any missing variable. So they share. If you look at what's below, I get two oil companies and Nokia. And Nokia is strange, you know, disrupted company, you can throw it aside. But when you see two commodity companies fall below the line, you say, what might I be missing? And it turns out that in 2010, here's what you were seeing. You were seeing net income for 2009 driving the return equity. But oil prices had dropped since that. So the price had dropped for these companies reflecting lower oil prices, but my return equity was lagging because that number hadn't been updated for the lower oil prices. See, this is what you're going to do. Why are you wasting your time? You're explaining away everything that is mispriced. This is the 100 largest market cap companies in the world. I would be extraordinarily surprised if I found a significant pricing mistake here, because these are the companies that everybody's seeking. But if I took 100 small cap companies, maybe under the radar companies, then I'm more likely to find a market mistake because somebody's missing something. So it doesn't surprise me that there's good reasons for where the companies fall. But at least as my starting point, I can see what's overpriced, what's underpriced. And then at this point, at least I can explain almost all of the overpricing and the underpricing. But as I said, one of the things I'm missing is growth. So this is it makes my mind spin whenever I do three-dimensional graphs. But in a standard scatter plot, you got two dimensions, price to book, return equity. What am I worried about? Growth. So I added a third dimension. What you're creating is the equivalent of a cardboard box, right? You've got three dimensions. And here's what I want you to tell me. Where on this graph are my cheap stocks? Obviously, you want low price to book. You want high return on equity. So basically, so low price to book, high return on equity. And you want low growth or high growth? You want high growth. So basically, I'm looking in that corner, right? Low price to book. There's nothing there. The closest I get is TWX, which is Time Warner. Again, I'm not surprised. These are the 100. So basically, with the three-dimensional graph, you're looking for that combination of low price to book, high return equity, high growth. And it turns out that that's the corner of the box. And that's, if you find something there, then take a closer look. That's a cheap stock. I could even do risk, price to book, return equity, beta. Again, I'm looking for low price to book, high return on equity. And do I want a high beta or low beta? Low beta. So I'm looking in that corner. The closest I get is ExxonMobil. Yeah.
But here you are like trusting the forecast of the others.
I'm sorry, what?
Trusting the forecast of the others.
Oh, absolutely. No, I'm not even trusting a forecast. I'm just using actual return equity.
No, but for the growth.
Oh, for the expected. Well, they're all kind. I'm trusting the accountants for existing return equity, right? I'm trusting the accountants of book value. You're trusting somebody everywhere. So the question is, do I actually trust analyst forecast of growth more than accountants estimate of book value and net income, to be quite honest? So it's true, but it doesn't matter, right? As long as let's say they're biased upwards. If they're biased upwards for every company, this should still work. So unless you can tell me a story about analysts being biased upwards for some groups of companies and not for others, the fact that I'm trusting a biased source shouldn't even make a difference. It's a pricing. Everything is relative. So finally, I said, you know what? My head was spinning with these three-dimensional graphs. So I said, let me go back to my old trusted regression. And here again, I took price to book ratios against beta, growth rate, and return equity. There's the R squared, 66% of the variation in price to book ratios across the 100 largest market cap companies can be explained by these three variables. All three are statistically, I'm sorry, beta is not, but growth and return equity are statistically significant. But it turns out that the market doesn't seem to care much about beta, at least as a proxy for risk across these 100 market cap companies. Maybe there's some other proxy, maybe risk doesn't matter that much. Once you become one of the 100 largest market cap companies, you're viewed as safe enough that the differences in equity risk kind of go away. Now, if I were using this regression, you know what I would do next? I would take out beta from the regression. Never run a regression where you have a variable that is not statistically significant staying in the regression, because then when you use it to make predictions, you're using something that's pure noise throwing off your predictions. And if your answer is, but it should matter, it doesn't matter what you think should matter, what I think should matter. It's what the market thinks should matter. So if market says, we don't care about return on equity, do price to book ratios, that will trouble me. But guess what? I'm going to take return on equity out of the regression because this is a pricing. Pricing is all about reflecting what the market cares about. And if that troubles you, go back to doing intrinsic valuation, because there you can make your own judgments on what should matter and value the company. But pricing is about taking what markets factor in. Any questions? So I updated that scatter plot to January 2022. So I'm not going to tell you any deep stories here, but I did take a look at the most undervalued. There's nothing that falls outside the lines, but let's see what gets close to the lines. Let's go undervalued. Notice the pattern there. What do you see as the three companies I've highlighted? Citicorp, Goldman Sachs, JP Morgan. That can't be coincidence. At the start of 2022, for whatever reason, if you looked at a combination of price to book and return equity, banks look cheap. Now, that might be because people don't trust return on equity at banks anymore, because remember, for the last decade, we've had these shocks come in every 3 or 4 years where companies claim to make a lot of money, then take this big loss. Maybe it's a reflection of loss of trust. Or maybe it's just banks are cheap, that's the sector I should be putting my money. Of course, we just learned that if you saw the earnings reports coming out now, Russia is having a much bigger impact on banks. So you're seeing the net income start to roll down. JP Morgan was, I think, net income was down 38%. So maybe if I redo this chart in 2 weeks after all the banks have reported trailing 12-month numbers, and you can try this, because all I did, I went to S&P Capital IQ. I looked for US banks. I downloaded the price, the book, and the net income, and you can use trailing net income and update this and see if, in fact, some of this difference disappears. I looked at the stocks that came in as most expensive. One surprised me. First is Uber. Yeah, obviously, for multiple reasons, it is going to look, it's a growth factor, that's it. The MMC is a real estate company. And I think Equix, if I'm not wrong, is another, if somebody wants to look up Equix on their online. But last time I checked, MMC definitely is a real estate, Marsh McLennan. And so the extent that housing is getting pushed up, maybe that's what explains it being overpriced. But you can see again common features that push these. It's a construction company. Okay. So basically there's a housing, I'm sorry, go ahead.
Yeah, Marsh is, I don't know if it's real estate.
It's some kind of real estate related, I thought, right?
Sure.
Is it really Marsh McLennan? Okay. So those are the three company. So what?
It's a consulting company.
Consulting company. Who are its primary clients?
Financial services.
Yeah. So it'll be interesting to take a closer look at why these companies look overpriced, but those came out as the most overpriced companies. So we looked at price earnings, price to book. Let's move forward with the final example. I'm now fired as this general analyst. I am now the trucking analyst. Talk about being in hell, right? This is a sector you don't want to deal with. And this is again an old table, but I want to use it to illustrate a point. So those are my trucking companies. I'm using EV to EBITDA. Why? Because that's a commonly used multiple. I look for low EV to EBITDA, and I'll latch on to a company that looks really interesting. Second to from the top there, Ryder Systems. And we've all seen Ryder trucks around the country. It's a well-known brand name. It seems to be trading at 2.8 times EBITDA. Looks really cheap. So when you look at Ryder Systems on an EV to EBITDA basis, it looks cheap. So I'm going to give you a chance to ask me the questions you need to ask when something looks cheap on an EV to EBITDA basis. Remember the list we went through? What's the first question you're going to ask? Growth, right? These are all boring low growth companies, so that's not the issue. If Ryder Systems were low growth and everybody else were high growth, that might explain it. So it's not growth. You could look at risk, cost of capital. If Ryder Systems were an Argentine company and the rest were US companies, would explain it, but they're all US companies. They all have pretty much the same mix of debt and equity. Tax rates, remember corporate tax rates matter? I looked at the effective tax rates, look roughly the same. Now it looks deeply puzzling. So I looked at reinvestment. And there's something about the trucking business on reinvestment that I need to put in as background. The way the trucking business reinvested replaces its entire fleet of trucks every few years. And they usually do the whole fleet. They don't do 20 because there's economies of scale of doing it at one go. So I'm going to give you a chance to ask me a question about the trucking fleet they have that might tell you something about reinvestment. How old is the fleet, right? And Ryder Systems had one of the oldest fleets in the business. You know what the market's looking at, right? It's looking at this whole thing will need to get reimplemented. It looks cheap. So you buy the stock because it looks cheap. And 6 weeks from now, you're going to wake up to a massive capital raise that the company has to do to buy new trucks. I actually pulled this off an equity research report where they said Ryder Systems looks cheap. And I actually was able to get the average life of the fleet for every company in the sector. This is in the public domain. And that's what I mean about lazy pricing. If you're going to call something cheap, at least you should have the obligation to go in and check off all the boxes. Because if you can do that, there's nothing wrong with pricing. You're asking the right questions. I know you're getting a little tired of the sector by sector. But let's take the grocery sector. I told you trucking is boring. Grocery sector is beyond boring. Right? Margins are at 2%, 3%. There's no high growth in this business, at least for most grocery stores. So in 2007, I plotted out the grocery stores. They all look like they, and based on price to sales. So ignore that. I should have really used EV to sales, but let's say price to sales and net margins, and they all look like they fall, except for the odd man out. 2007, that odd man out was Whole Foods. Very different from the traditional growth. This was early Whole Foods. You're saying they're organic. The organic and inorganic doesn't show up in my valuation. It was a high growth grocery store with much higher margins. So when this first started, grocery analysts who are used to these boring companies look at Whole Foods and they say, oh my God, look at that price to sales. And then look at the margins and say, okay, that explains they have higher margins. But that's kind of sloppy, right? Of course, it should have a higher price to sales, but how much higher? So here's what I did. The net margin in 2007 was 3.41%. The typical grocery store had like 2% margins. I ran a regression of price to sales against net margins. You plug it in. Your predicted price to sales should be higher than the typical grocery store company, but not where it's at. So in 2007, you look at Whole Foods, it looks massively overpriced. 2009, I revisited the sector. Again, I took price to sales, net margin. Whole Foods net margin had dropped to 2.77%. And you look at where it is on this, it's gone from being the most overpriced company in the sector to one of the most underpriced companies in the sector. From most overpriced to most underpriced. 2010, I looked at them again. I know you can't even find them, but they're actually right. You know, they've gone back to being overpriced. Overpriced in 2007, underpriced in 2009, overpriced in 2010. And then you can keep an eye on this graph going back. It took almost until 2012 or 13 before Whole Foods kind of converged on the line. You think, what does that all mean? When you have a disruptive company in a sector, analysts have no idea what to do with it. If you, especially if you're doing pricing, you say, what do I do with Tesla? You're an auto analyst in 2009 or 2000. I don't even know how to handle it. You're going to get this phenomenon of overshooting, undershooting. Eventually, you learn enough that you bring the company into the fold. But before you think of this as a bad thing, this is how you make money on pricing, right? You make money on pricing mistakes. And if you can get a little ahead of everybody else, and that requires some work, your biggest chances with Whole Foods were between 2007 and 2013. By 2014, people had learned how to deal with Whole Foods. You're saying, that's it, I'm done. Well, Whole Foods in 2015 was pretty close to the line, but guess what you see popping up? There's a new kid in town. It's a company called Sprouts. It's now your high growth company, very different. It's much smaller. Typical Sprouts has square footage about a quarter of the square footage of a typical grocery store. And again, people are puzzled. What do I do with this? So when you look at a company that's coming into business with a very different business model, you take Airbnb in the hospital, a hotel analyst will have no idea what to do with Airbnb. And that's a good thing if you're even if you're a trader, because you're essentially taking advantage of because they're using a metric designed for old hotel companies trying to apply it in Airbnb. So think of this as an opportunity if you're a trader, when you have a company that's very different from the norm, doing things differently. People will misprice it. They will overshoot and undershoot. Eventually, they will learn enough. But by then, it's too late for you and I to actually trade on the company. You're taking advantage of that learning process. One final example. Remember that Amazon valuation I showed you from January 2000? I'll remind you of what I found there. I did a discounted cash flow valuation of Amazon. I came up with a value per share of $35. Stock was trading at 84. And it was pretty conclusive. I said, I think the stock is deeply overvalued, but I also said, look, I'm not going to sell short because I have no idea what the market will do. At exactly the same time I did that DCF to come to that conclusion, I decided I want to price Amazon. So in January 2000, I wanted to price Amazon. First, I picked comparables. I picked all the .com companies or companies in the sector. And then I started looking for a multiple. And I ended up using a price to sales multiple. Why? Desperation. I think there were 51 companies in the sector, only one of them, AOL, was making money. Every other company was losing money. So I can't use PE ratios. I can't use price to book. The book values are negative or close to zero. Ended up using price to sales. And of course, we know the companion for price to sales is net margin. So I plotted out net margin. And most of the companies had negative net margins. But when I was done putting up the scatter plot, I took a look at it. And my first reaction is that looks like a shotgun blast. There's no pattern that you see there. I mean, if I ask you to fit a line through that, you're going to go crazy because it's very difficult to find any kind of detectable pattern. But I decided I was going to try anyway. So I took my statistics back and have a best fit line. It came back. You know, you have to give credit to regression packages. They basically fit the line through any data, and it did. But then it told me, look, the T statistic on net margin is 0.49 and the R squared is 4%. Basically, they said this is just noise, and I'm showing you it's just noise. Now, at first sight, you might find that surprising. Our net margin, high net margin companies support. In this sector, I'm not in the least bit surprised. And here's why. If you were buying a .com stock in 2000, were you buying it because of how much money it made in 1999? I don't think so. In fact, tell me what all the things that will lead you to have a higher price to sales ratio for a .com stock in early 2000. What are some of the things you're going to look at? Rather than net income last year. So you're going to look at growth, right? Some proxy for growth, growth in revenues, growth in subscribers. Higher growth companies should have higher price to sales ratios. You also know that these are young companies losing money, that some of them are going to go under. They're not going to make it. If I could give you some proxy for survival, you're probably going to price companies that you think will survive at a higher price than companies that you don't think are going to survive. And third, these are multiples of revenues, right? When you have revenues of just $1 million, remember some of these .com companies were tiny. You can trade at 100 times revenues, but as the revenues scale up, you'd expect the multiples to decrease because you can't pay 100 times revenues, the revenues of 5 billion or 10 billion. So here are my hypotheses. Companies with higher revenue should probably have higher price to sales ratios than companies with, lower price to sales ratios than companies with lower revenues. Companies with higher growth should have higher price to sales ratios than companies with lower growth. And if we can somehow find a proxy for survival, companies that are more likely to survive should have higher price to sales ratios than companies. So I wrestled with, how do I get a proxy for survival? You're saying, why do you look up a rating for the company? There are no ratings. These companies don't have bonds. How do you know, if you have a young company, what is usually the event that causes you to shut your doors? What happens? You just run out of cash. I mean, basically, you run out of cash. Once your checking account hits zero and you can't access capital, you're dead in the water. So I know it's a very rough proxy. So I took cash, the cash balance that these companies had, as a percent of revenues. And I hypothesized that the larger the cash balance you've accumulated as a company, doesn't mean you're not going to fail, but you can put off failure. This is a metric that a lot of analysts did in the late 90s. They kept track of what was called cash burn. How many months of cash do you have on your balance sheet? Because as that number goes towards zero, you're more and more dependent on raising external capital. I ran the regression. I got an R squared of 32%. Now, normally an R squared of 32%. I'm a little disappointed. But in this sector, I was elated that I could explain 32% of what was going on in this crazy sector, just using traditional variables. Coefficients, revenue, I should probably take up. I use log of revenue, and I'll tell you one of the reasons you use log is if you have big differences on a variable. Let's say that the lowest company is 0.05, the highest company is 15 trillion. If you leave them as absolute numbers, it can wreak havoc on your regression. All that logs do is they narrow the difference and make your regression more manageable. So it's a little trick you can play whenever you have these big differences, especially with absolute numbers. Of course, when you're doing ratios, this is not an issue, but with dollar values. But if I took that regression and plugged in the numbers for Amazon, remember, this is right after I did my DCF valuation. I plugged in Amazon's log of revenues, Amazon's revenue growth rate, 199%, and Amazon's cash. They had a cash balance of 30% of revenues. My predicted price to sales ratio for Amazon is 30.42. It was actually trading at 25.6 times revenues. So remember, this is right after I've done my DCF. I've told you the stock is overvalued by 60, 70%. It's trading at 35 versus 84. At exactly that same time, in the same breath, I'm saying, oh, by the way, it's also cheap. But I should condition that statement, cheap relative to other .com companies. In fact, anytime you do a pricing, remember, it's always a conditional conclusion. Given how other .com stocks are being priced, Amazon looks cheap. And both those conclusions would have been right 1 year later. 1 year later, what happened? Amazon was down 80%, vindicating the intrinsic value overvaluation, but was down only 80%. You're asking, what do you mean only 80%? The rest of the .com sector was down 95%. The pricing did its job. But remember, pricing won't protect you from losing money if every company is overpriced. It just means you will lose less money than other people in that sector. And that's why I think you need to be careful when you see a buy recommendation in an equity research report. What's the analyst saying? Given these 14 other companies, I look at this company. He's not saying the company is cheap. He's saying, given these 14 other companies, it looks cheap. He's not lying. Even if he's done his work, it's a conditional statement. Should you buy? Depends. If you're a long-term investor, this buy might have no meaning to you because you don't care whether something looks cheap relative to other companies in the sector. You care about cheapness relative to cash flows and growth and risk. So that's the first thing you can try. Is your regression doesn't work because you have a young company in a sector. So let's say you're doing Uber and you run the regression, nothing works. You can try a regression with these proxies for what you think matters. Maybe the number of riders matters. Maybe the growth rate matters. Here's the second thing that analysts often try in sectors where companies are young. Well, the problem you face with young companies is what you have on the ground right now has no substance, right? The revenues are small, you have big losses. What if you could project out revenues and income for these companies 5 years out, 10 years out, which is what we do in DCF? Couldn't you price companies based on future revenues? It's called a forward multiple. In other words, people will take today's price, project out revenues 10 years out and say, this company trades at 3 times 2031 revenues. A lot of equity research analysts with young companies in sectors which are young will often use forward multiples. And I'll tell you up front, many of these growth companies will look incredibly cheap on a forward multiple basis. I mean, even Tesla at its current prices. If you project revenues out 10 years out and you tell me it's going to be 500 billion, all of a sudden the $1 trillion you're paying doesn't look too bad. It's like only 2 times forward revenues. But here's my cautionary note. There's many a slip between here and the lip being the end number. In fact, when I valued Tesla, this is a long time ago. You know, when you look at the terminal values and all of my discounted cash flow valuations of young companies, you can take the terminal value is actually higher than the price today for most of these companies. And people say, well, that must mean it's a good investment. The value today is 6 billion, your terminal value is 10 billion, you must make money. And the reason it's misleading is for multiple reasons. The first is the terminal value is 10 years out. So the first is if you bring that terminal value back to today, even without adjusting for risk, let's say you took the risk-free rate. So this was from 2013, my terminal value was 68.8 billion. You discount back at the risk-free rate, I've lost about 16 billion. So basically the first is pure time value, no risk factor even considered. Second, if you factor in risk, it's going to become even lower. That terminal value is not guaranteed. So if I just discount the terminal value back, already I've lost a big chunk. But that's only a piece of the puzzle. This was when Tesla was making 24 and selling 24,000 cars a year. And in my valuation, I was projecting that they would sell a lot more cars, right? Which requires that they build more assembly lines, reinvest. If you factor in those new equity issues, those negative cash flows that I have for year 1, 2, 3, 4, and 5, that value gets down even more. In fact, by the time I clean up for all of the things I need to clean up in a DCF, what looks like this incredibly attractive terminal value can very quickly become a fraction of that number. So when somebody says this stock looks cheap because it's trading at 2 times 2031 revenues, before you fall for it, start asking questions. What is that worth today? How much of that will I lose because I have negative cash flows? And by the time you're done, you might conclude that that's not a bargain at all. But forward multiples, analysts love them because they make things look cheap. Because you're dividing today's price by something that you think will happen 10 years out. So if you decide to do this for your companies, you'll have to do forward revenues for every single company. You might have to substitute analyst estimates, much as you distrust them because you can't be projecting revenue. You projected revenues for your company, but you can't be projecting revenues for 50 other companies. You'll have to find a source. I think S&P Capital IQ has forward revenues at least 3 years out. You might decide market cap today divided by forward revenues and see how it plays out. So first, so if you have a young company and you try regression with current numbers, nothing works, try proxies like I did for Amazon. You can use forward numbers. Let's say that doesn't work either. Now you're truly desperate, right? Remember what the question you're asking, right? The market is pricing companies in this sector at different numbers. What is the market looking at to come up with this pricing? So I'll take you back to October of 2013 when Twitter went public. And I'd done a DCF valuation of Twitter. I think I came up with $18 per share. And then I wanted to do a price hit for Twitter. So I went and collected the market caps of social media companies, all of whom got at least some of their revenues from advertising. So these are all publicly traded. There are the observable market caps. I collected all the numbers that should drive market cap. I looked at revenues, EBITDA. So I said, let me collect all the financials. And then just as a throwaway, I said, let me also find out how many users each of these platforms has. You're saying, what do I do with this next one? What are you trying to ask? What is the market looking at when it's pricing these companies, right? So I did a correlation. I said, I don't know. Let me look at what drives the market cap. Is it revenues? Is it EBITDA? Is it EBIT? The number that dominated on every single proxy was the number of users. In other words, the market in 2013 was pricing social media companies based on the number of users, not on revenues, not on EBITDA, not on EBIT, none of the financials, number of users. Your first reaction is, that's irrational. If you're doing pricing, that word shouldn't even cross the surface of your thinking, because what's the essence of pricing? You essentially let the market tell you what something is worth. You've entered that room. You can't back out now saying, I don't like what the market is doing. The market essentially is pricing these companies based on number of users. And if you look at the median value, at least in 2013, the market is paying about $100 a user. Remember, I was doing this for Twitter and I'd done a full-fledged DCF. I said, I'm going to try a pricing. Clearly, it doesn't matter what your revenues have, but none of those multiples are going to work. It looks like users are what matters, and the market is paying about $100 a user. Twitter had 240 million users when it went public. See where I'm going to go next? But 240 million users. Each user is worth $100. 240 million times 100 is 24 billion. That gives you a market price of around $45 per share. And this might be pure coincidence. But you know what Twitter opened at when it went public? Around $45 per share. If you're an investment bank, you know what the lesson here is, right? Somebody wants you to do an IPO. They want you to touch pricing. It's a social media company in 2030. Here's what you're going to do. You're going to take the number of users, multiply by 100. You're going to come up with a number. You're going to write it very carefully and hide it away. And then you can say, I can't say this is how I came up with the number. It just doesn't look sophisticated. You're then going to create some kabuki discounted cash flow valuation with made up numbers. And you're going to keep playing with the numbers till you have roughly 24 billion. And this is why I think a little more honesty in this. Think of how much time you could save out of this, right? That poor guy, low man on the totem pole, low woman on the totem pole, is working 6 days, 16 hours a day to back up a number that you already written and put into your front top drawer. Why are you making people waste their time doing these discounted cash flow valuations when we know it's all about pricing all the time? I mean, if you want to see something like, take the cloud business, right? Don't take the big cloud companies, take all the small cloud companies. Look at how they're priced. How do I explain this? All of the traditional financial metrics, nothing is going to work. Get creative. Think about what it is that investors in these cloud companies are attracted by. Same thing with electric cars. Even revenues don't work for Lucid, and Rivian, and Neo. How the heck am I going to explain difference? So in a sense, you're stepping back and saying, and this is why I think having content for traders gets in the way. Because we will view them as idiots. You're going to say, oh, of course they're looking at nothing. Nobody's putting numbers based on nothing. They're basing it on something. You and I might not like what they're basing it on. You're trying to back out what it is. I'll throw a hypothesis out. I haven't tested this out. I have a feeling that if you took the social media followings of the CEO of a company, and you took the market cap of a company, the correlation is surprisingly, I'm basing this on a sample size of 1. Right? I'm basing it on the fact that Elon Musk has, 86 million followers. But I wouldn't be surprised, and I should do this. I should be able to get the CEO, take his Twitter account plus Facebook plus Instagram plus Tinder or whatever else he's on. Take them all, put them together, take the market cap of the company, see if there's a link. And I wouldn't be surprised. And I think it explains some of the weird stuff we've been seeing. You heard of SPACs? These companies that are kind of essentially their front companies eventually do an IPO. If you get a chance, go back and look at SPACs have kind of fallen out of favor, but at the peak last year, take a look at who people were signing up as people running the SPAC. So there's usually a lead grifter. Somebody like Chamath Palihapitiya, who does 1,500 SPACs. But there are all these other people together and say, why is he in a SPAC? Shaquille O'Neal was part of the SPAC created by, I think he's the guy who owns the Sacramento Kings. He had put together a SPAC. I don't know who WeWork. I think they were going, you think Shaquille O'Neal must have some deep insight into real estate transaction. Shaquille is actually one of the smartest sports people out there in terms of businesses, but I don't think they brought Shaquille O'Neal because of his real estate insight. You know why they brought him in? He has 3.5 million followers, 5 million followers. You're saying, why does it matter? If pricing is being driven by followers, what are these SPACs trying to do? You want to get people with big followings in your group, because to the extent that pricing has been driven by that following, you think that doesn't make any sense. It doesn't have to. Pricing is about what is the market being driven by. So now I'm going to take a step back from, because we've looked at 8 different sectors. Some it worked, some it didn't. But if you're saying I'm pricing against other companies, it's statistics, right? And the rule in statistics, bigger samples are more powerful than smaller samples. So what does that mean? What if instead of pricing my company against a sector, I priced it against the entire market? Your first reaction is, but I can't do that. The risk will be different. The growth will be different. The cash flows will be. You're absolutely right. But what if I could control for those differences? Like, I mean, essentially, that's what a regression does. So starting about 25 years ago, at the start of every year, after I put together my big data sample of every publicly traded company, I would take each of the multiples and I would take the variables that should matter. It's not a kitchen sink regression. And the variables that should matter come from the analytics, right? P, it's growth, payout, and risk. And I said, let me see how much of the differences across companies I can explain with fundamentals. So at the start of 2022, I started with P ratios. And what's the conventional wisdom with P ratios? The key variable should be growth. I ran a scatter plot of P versus growth, and it freaked me out. What are you looking at? What do you see in that graph? If there's a link between P and growth, it's not obvious, right? There might be some loose link, but the link is pretty poor. It sets me up because when I run the regression, you know what I should see, right? If the strongest variable explaining a multiple is a plot like this, I should expect to see an R squared of 80%, 85%, 90%. What I saw was an R squared of 5%. That is the lowest R squared I've had with the PE ratio regression going back almost 25 years. There's something strange going on with PE ratios at the start of 2022, and I can tell you what it is. The PE ratio through the start of 2022 used trailing 12-month data, which is September of 2020 through September of 2021 for most companies. The COVID effect is wreaking havoc on earnings per share. Will it go away? Yes. If I run this regression 3 or 4 years later, now assuming that you don't have another big global shock, you should expect to see it work better. But the low R squared is what it is. Okay? Do I like it? It's not a question of whether it is what it is. It reflects the fact that PE ratios are going to be really difficult to explain at the start of 2020. That's how I read the R squared. When you look at the coefficients, all 3 of the variables are statistically significant. Now, part of you is saying, how can the R squared be only 5% and the variables be statistically significant? It's a law of large numbers. When you have really large samples, you can get a low R squared, but still get a regression you can use. It's going to come with a big range, but those variables. Let's look at the science. Higher beta stocks have lower P ratios. Kind of makes sense, right? Higher payout ratio stocks have higher P ratios. Higher growth companies have higher P ratios. So at least in the start of 2022, the coefficients made sense. They look like what I'd expect them to. Now you might say, well, what am I going to do with this regression? Before you get any further, it's time for a very quick review of multiple regressions. So I don't know whether you remember this, when you run a multiple regression, there are a bunch of implicit assumptions you make. The first is you're assuming that the relationship between the independent and the independent variable is linear. And the world has very few leads. So that is quite a stretch, right? If growth doubles, PE doubles, that's what I'm implicitly assuming. Second, I'm assuming that during this period, there was nothing happening that was changing the structure. So if I were running this in 2020, something definitely did happen and it's going to affect it's called non-stationarity. And the third is something that we kind of talk about in statistics. And we say, what the heck is he talking about? It's called multicollinearity. When you run a multiple regression, the independent variables you use are supposed to be uncorrelated with each other. So you take Y as independent variable, A, B, and C as independent variables. The A, B, and C should be independent of each other, uncorrelated. What are the 3 variables I use? Growth, payout, and beta. There's not a snowball's chance in hell that the 3 are not related to each other, right? If I take high payout companies, they will tend to be low risk companies and low growth companies. It's almost a given. We have a problem statistically. I'll talk about what you can do about the problem, but let's see how big the problem is. So first is you worry about statistical insignificance. So let's get that out of the way. What if you run this regression? In 2022, all 3 variables look statistically significant, at least in the US. But what if you run the regression and one of these variables is not statistically significant? Take it out. Don't sit there saying it has to matter. I'm going to leave it in. So I use, you can use whatever threshold you want, but I use the P statistics. There are also F statistics. You can use any variant thereof. If something is not significant, don't leave it in your regression. The second problem you have to deal with is sometimes when you run this regression, your intercept can be negative. What does that mean? Statistically, it means nothing, but it does create problems for you. And here's why. If your intercept is negative and you use that regression to get predicted PEs for companies, for some of your companies, you can get negative predicted PEs because you start with a negative number, you might never. You're saying, so what? We know a PE ratio can never be below 0. So one way you can fix this is most statistics packages, when you run a regression, will allow you the option of having no constant. Basically, it forces the regression through the intercept, through 0. It's not a great choice because what you're doing is you're taking your best fit line and making it less best fit. But if you're getting a lot of negative PEs, it might be a small enough price to pay. So if you have coefficients which are insignificant, you can take them out. If you have a negative intercept and it's giving you a lot of predictions which are negative, then there's a way to fix it. And finally, if you look at the multicollinearity problem, let me outline how big it is. Beta growth and payout. If this were a perfect regression, you know what you should see in those. So the ones, of course, would be always the case. But across the independent variables, all of these correlations should be 0. You might wonder what the 2 stars and the 1 star, those are correlations that are significantly different from 0. So let me list out what I'm saying. I'm seeing that high growth companies tend to have low payout ratios. Am I surprised by it? Not in the least. I'm finding that high growth companies have higher betas. Am I surprised by it? Not in the least. I'm finding essentially what I expected to, which is multicollinearity is a real problem in this regression. Here's what it's going to end up doing in a regression. Actually, your overall regression will still work, but the coefficients can now start to take on signs you didn't expect. In the 27 years I've run these regressions, betas have had negative coefficients in 17 years, which is what I'd expect. But in 10 of those 27 years, betas had a positive coefficient. You think, how the heck can high-risk companies have higher PE ratios? Well, let's say most of the companies with high betas also have high growth rates. Remember, your computer doesn't see beta or growth. It just sees 4 columns of numbers. And after a while, it starts to get really confused because it doesn't know which number is a better proxy for growth. Beta is actually becoming a better proxy for growth in some years than it is a proxy for risk. What I'm trying to say is when you run a regression, you get a coefficient that has the wrong sign. Often the culprit is multicollinearity, which is you thought you were putting this variable to measure growth, but it's happening to measure risk instead, because the two tend to move together. So I've never actually, there are actually statistical ways you can try to fix multicollinearity, but here's the challenge. The more sophistication you build into your statistics, the more skeptical people will get about what you're really trying to do. I'd rather keep it simple and make people aware of the limitations than try to go down the statistical route and hit people with some weighted least squared, adjusted regression. And to begin with, the regression is already throwing them off. You throw all this other stuff in front, they're shutting down, saying, I have no idea what you're talking about. But here's the bottom line. The reason I'm running this regression is to price companies, right? So how do I use it? Let's assume I came to you with Disney at the start of 2022. I told you what Disney's expected growth rate is, and I said, I've done the research, 15%. Its beta is 0.90, and its payout ratio is 20%. I say, is Disney cheap or expensive relative to the market? There's my market regression that you saw a couple of pages ago. If I go in and plug in Disney's values, I get a predicted PE for Disney of 35.8. You're saying, what does that even mean? Given how the market is pricing all other stocks, Disney should be priced at 35.8 times earnings. Let's say it's actually trading at 38 times earnings. It's actually slightly overpriced. Maybe remember the R squared is not 100%, it's 5%. So the range I'm going to get is going to be pretty wide, probably close to fairly priced. And let's say I do this for stock after stock. I have 7,200 stocks. I run this through the 7,200. For most of them, I'm going to find that the price earnings ratio is not different enough to do anything. But let's say at the end of the process, I find 20 stocks that are deeply underpriced and 20 stocks that are deeply overpriced, they fall outside the range. If I trust my pricing, what can I do next? If I run a hedge fund, what could I do?
Long short.
I buy the 20 cheapest, sell the 20 most expensive, then get down on my knees and hope and pray what happens. That they converge on the line. You heard of quant funds, they're big. That's what quant funds are doing at a level of sophistication far higher than this. They're working with much richer data. They actually have intraday data. They're using more sophisticated statistical tools. Think of them as regression squared, regression cubed. And they're doing exactly the same thing, is they're using these quant models to price stocks and detect cheapness or expensive, but they're just as susceptible to noise as the rest of us, which is why hedge funds sometimes blow up, is because that pricing convergence is not guaranteed. So that's why we run market regression, so we can price companies and we can essentially see this process play out. There's one piece of that PE ratio regression that I latch on to every year. Remember my growth coefficient had this 0.49. What does that mean? Every 1% difference in growth rates across US companies, the PE ratio goes up by 0.49. Think of that as the price the market is willing to pay for growth. In this graph, I've kept track of that number, that's a red line. I've also kept track of the implied equity risk premium every year. You think, why is that in there? What's implied equity? It's a price of risk in the market, right? So risk is a bad thing. The market punishes companies by pricing that risk. Growth is a good thing. It prices companies by pushing up the PE ratios. Your best possible scenario for a high growth, high risk company is what you saw in 2000 and 2001, which is markets paying a huge price for growth and charging very little for risk. That's a peak of the dot-com boom. Essentially, is it rational? It doesn't matter. That's what the market is doing. Over time, those numbers have gone up and down, and I keep track of those numbers because I don't want to be caught in a 2000 type mispricing again. So at the end of 2022, the price on growth is now back down again, partly because many companies are now reporting growth because their base year is 2020 for many of the companies. So part of this is a base year problem. Growth has become magically cheap because so many more companies, even mature companies, have high growth rates because they're building off a really bad year. That'll pass. My guess is we'll start to see a bounce back in that number. But that's the advantage of this regression, is now I can tell you what the market is willing to pay for growth. Big jump in coefficients, again, because that year was a year that you saw growth come back. You had a recession. Again, anytime you have a recession, growth is going to now become much higher for everyone. So you're going to see growth become scarce and easy to find at different points. So when everybody is growing, the price of growth will go down. When very few companies are growing, you're going to see the price of growth go up. Now let me take one other multiple and put it to place. And this is kind of to show more statistical issues. Remember we talked about linearity? With PE ratios, one way you can check linearity is you can take PE versus growth, PE versus beta, PE versus payout, and you do a scatter plot, and they're pretty linear. It's not bugging me. But I want to do a regression of PEG ratios. So what I did was I took PEG ratios against growth rates. And I knew I was going to have a problem if I ran a regression. If you did, I know this might be reaching, but it looks to me that if I were to draw a line, it'll be this, it's not going to be a straight line, it's going to be a line that curves. Whenever you have a non-linear relationship, statistics professor would kill me for saying this. You know what I find works for me? Take your independent variable and take the natural log of it. It's amazing, 95% of the time. You do that, here's what you get. This is price earnings against the log of the growth rate. The natural log, the small ln, not the big. So basically, if you're using a calculator, make sure you're hitting the right button. This looks like a much more linear relationship, right? So when you're doing these market regressions, it's really statistics that's coming into play. In fact, my PEG ratio regression, my R squared was a little higher than PE ratios. It's still beta growth payout, but now it's log growth rate because I want to use the log to get a more linear relationship. And the t-statistics basically reflect the significance of each of those variables. So that's what I spend the first week of every year doing, is I collect the data. In fact, this is my last task, and that now the fifth day, now after I've got all the numbers nailed down, I start running regressions. P, price to book, EV to EBITDA, EV to sales. And here's what I used to do just for the US, but now I do it for the world broken down into regions and globally. Why am I doing this? Because if you came to me with an emerging market stock and say, is this cheap or expensive? I can't put in the P ratio regression for the US. Wouldn't make sense. I have a global regression that I could still use. Notice beta, payout, and growth show up in every single one of these regressions. That's why I call them, they're not kitchen sink regressions. You know what kitchen sink regressions are? We're all guilty of them in statistics classes. What's your objective? To maximize R squared. So what are you going to add? Anything that increases your R squared. That's not my end game. To explain what I can actually observe. So you can see the R squareds vary across markets. I can explain a lot more of the variation in PE ratios in Australia, New Zealand, and Canada than I can in the US. That's not always the case. In different years, you see the numbers shift. Now, I won't bore you with it, but basically PEG ratio, again, you see the log, the growth rate show up. So it's basically running the same regression for different regions, globally, different R squareds again. The coefficients shift across different regions, which means how much people are willing to pay for growth in the US can be very different from how much they're willing to pay for growth in Japan. Okay. There's price to book, right? Notice it's, again, I'm going back to the analytics, growth, payout, risk, and now return on equity. By far the dominant variable in every one of these regressions. Again, it shows you how much more we share in common across markets. The same variables that drive price to book. It drives me crazy when people push back and say, can you do an Indian version of a price to book? And so what exactly do you expect to be different in India or in Brazil? It's the same forces. The numbers can be different, but the variables remain the same. Okay. And since we're mopping up here, essentially I have regressions for enterprise value to EBITDA, enterprise value to invested capital, and take a look at the coefficients and go back and check the analytics, because these coefficients are there by design. They're designed to capture the things that showed up when we did the algebra last session. But these are the variables that drive the chart. So I'll send you the link for the regressions, because you can then get fuller output of the regressions. But nothing I'm doing here is rocket science. We have the data in S&P Capital IQ. All I'm doing is dumping them into an Excel spreadsheet. Now, Excel's regression function is a little weak, because I'll tell you one thing that drives me crazy in Excel is when you run a multiple regression, that at least as far as my powers lead me to believe, your independent variables have to be in contiguous columns. So I either have to move so it's a pain in the neck. Nice thing about a regression, an actual regression package, and in fact, there are some that are just add-ons to Excel. There's a program called Stat Plus that I like, which is an add-on to Mac Excel. PC Excel has actually a lot more add-ons you can use than just bring in a statistics package in. Or you can just bring out the heavy artillery, take, SPSS, SAS, RATS, basically a whole bunch of programs that have been around for 50 years, but now are available for the PC. But to the extent that you're going to be working with lots of numbers and you're going to be using statistical tools, I think it's well worth the investment in one of these statistics packages. Because at the end of the process, that's what you're going to end up with. So let's kind of mop up here. So you come up with define, describe, analyze, apply. There are choices you'll have to make when it comes to your company. Choices are, what are you going to scale? What are you going to use as your numerator? Enterprise value, firm value, equity value. And the answer to that will depend on you looking at financial service companies, in which case it's taken out of your hand. It's just equity value. Are you looking at companies where there are big differences in leverage across companies, in which case you probably are better off using enterprise value. Okay? Then you got to decide your scalar. You're going to scale to revenues, earnings, user numbers, and let the data drive your choice, right? There is no right answer here. Let the data drive your choice. You might also have to decide, am I going to use last year's earnings? Am I going to use average earnings? Am I going to use forward earnings? No right answer, but whatever you decide to do, make sure you use it for as many companies. And one of the things you should look at is how many companies do I end up losing because I picked the scalar. you have a sample of 30, you don't end up losing 23 of those companies because you picked last year's earnings and 23 of your companies lost money. And finally, you'll have to make a choice on comparable. Do you want to stay local? Do you want to go global? You want just companies of the same size? So that again will be determined by how many companies. There are 670 chemical companies. You'll have a lot of criteria you can add and still end up with a reasonable sample. You don't have that many automobile companies. You start to add too many criteria, your sample size will get too small. And at the end of the game, the question that I would leave you with the proposition that when you do pricing, you're always making a conditional statement. You're saying something is cheap or expensive, given these other things I'm comparing it to. And as a consequence, you're always going to be open to the risk that everything could be overpriced or everything could be underpriced. And this notion that you can find a perfect comparable, let it go, right? You're going to have to make compromises and try to control for the differences. That's about it. And I'll leave you with that. Define, describe, analyze, apply. Next session, we're going to talk about asset-based valuation, liquidation valuation, private company valuation. So last strands of that evaluation components.
Yeah. Okay.